OptionChampion.com.
Today is Saturday, December 10th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Well, there was another round of negative news on the economic front. The latest PMI, weekly unemployment claims, and PPI numbers were all reported this week. PMI came in at 46.2, down from the previous reading of 47.8, indicating a contraction in the U.S. service sector, while non-manufacturing PMI came in at 56.5, an increase from the previous reading of 54.4. Weekly unemployment claims came in at 230,000, in line with economists' forecast, and above the revised previous reading of 226,000. And producer prices ticked higher by 0.3% for the month of November, above the estimate of 0.2% and unchanged from the previous month's reading. Producer prices are up 7.4% from the same period a year ago. The latest wave of economic data rattled the U.S. equity markets. For the week, the Dow lost 954 points, the S&P 500 lost 137, the NASDAQ Composite lost 457, the Russell lost 96, and volatility gained $3.77. Crude oil lost $8.75 on the week, gold lost $2, silver gained 32 cents, and natural gas gained 8 cents on the week. Out of all the economic data that came out this week, the one that I wanted to be ready for was Friday's PPI number, the Producer Price Index. PPI measures the change in prices received by domestic producers of goods and services, and, in conjunction with CPI, the Consumer Price Index, is a leading indicator of consumer price inflation. Knowing that this metric can result in volatile swings in the market, I wanted to have a day position on SPY, the S&P 500 ETF. As a quick side note, because SPY is based on the S&P 500 index, both the stock and stock options have a healthy amount of volume, and they're very liquid, meaning they're easy to get in and out of. So for those reasons, when I put on a day trade in options, it is often in SPY because they have very active markets. Critical economic data such as payrolls, unemployment, CPI, and PPI are released before the market opens. With the latest PPI number coming out at 7:30 Friday morning, I needed to get my trade in around market close on Thursday. As the market was closing on Thursday, SPY stock was priced around $396 per share, and because the underlying stock could move sharply higher or lower on the release of the PPI report, I decided to buy a $397-$396 strangle with 6 days until expiration. I bought 5 $397 calls for an average price of $5.69 each, and 5 $396 puts for an average price of $5.70 each. So there was about the same amount of risk on each side of the spread. It's worth noting that this type of trade can be a risky one. At the time of the trade, the 397 call carried a 50 delta, and the 396 put carried a 48 delta, for a combined delta of 98. And with it being a 5-lot trade, meaning I bought 5 of each option, every point was worth $500. So given the type of trade and the size of the trade, Gains and losses can fluctuate very wildly as the option prices fluctuate. When the PPI number came out and was higher than expected, the markets opened sharply lower. When an underlying stock price goes down, call option prices go down and put option prices go up. With the market in a sharp decline after the PPI report, that was good for the put side of the spread. So I sold the 396 put at $6.60 for a profit of $455. The call side of the spread, however, needed some attention. The 397 call had moved down to $5.15, and I had paid $5.70 when I put on the trade. To keep the loss on the call from getting out of control, I reduced my position size by selling 4 out of the 5 lots at $5.15 for a loss of $220, and I waited for the price to rebound. When the price moved up to $5.30, I bought 4 lots and reduced my average price from $5.70 to $5.38. Luckily, the sell-off cooled down a bit and prices moved higher, and I sold the 397 call at $5.80 for a profit of $210. All combined, I closed the position for a profit of $445. This is when averaging down can be a beautiful thing. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.